Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
This is Jason Buck from the Mutiny Funds, and it is my severe pleasure to sit down with Jerry Haworth of 36 South. Now, Jerry to me is like the distinguished raconteur of the option space. A lot of times we talk to vol arb traders, and it's rare to find volatility traders that go back to the foundation of the VIX index from 2004 to 2006. It's exceedingly rare to find people that go back to the nascent option markets of the late 80s. And that's why I always love talking to Jerry. He has a vast amount of experience, and we're going to talk about that throughout today's cycle. And not only that, coming from Zimbabwe to South Africa to New Zealand to London to Bordeaux, not only does he have vast option experience, he has vast life experience, and he's always a pleasure to talk to. So Jerry, thank you for coming on.
It's an absolute pleasure, Jason, as always.
And so I want to start, you grew up in Zimbabwe, but your foundation in the markets came in South Africa. Kind of tell me about what was your entree into finance and just how did you get into the trading space?
Well, I did my thesis on the viability of an options exchange in South Africa. I discovered options very early on. I realized they were amazing. But at that stage, I don't even think the Black-Scholes model was available. It was available in Chicago, but not anywhere else. So, yeah, I kind of knew that's what I wanted to do. I eventually joined the Johannesburg Stock Exchange as the product development manager responsible for investigating launching a futures and options exchange with a view to end up trading. And eventually I got a job as a bond trader for a discount house and then moved over to equity derivatives, which is just starting. I got on the board of the new futures exchange, and I was right there at the beginning, and was very interesting. It was a bit of a wild west. I mean, we didn't really know what we were doing, but the margins were high enough to sort of cover all sins. It was really interesting. There were sort of equity-linked bonds that you could arbitrage with the futures. It was surprisingly sophisticated in that time. It was great fun.
Besides, I mean, obviously, fat spreads always help. But in general, was it just a absolute intellectual curiosity and complex problem solving that hooked you?
Yeah, it's because it's 5-dimensional. It's a lot more interesting than traditional stocks. And there always seem to be all the models are correct given their assumptions, but the assumptions aren't correct. So it always seemed to be there was it was an intellectual challenge, and still is many years later. The market has grown enormously, but it is still as fascinating as the day I first looked at it.
Yeah, and I think we'll get into overpriced or underpriced throughout this discussion and the creativity involved there. But there's also, you had a story about trading options via whiteboard at the nascent market. So tell me about what was the whiteboard and what were you guys doing?
Yeah, so there was no portfolio management system for options. In fact, we wrote one. But before that, we just simply bought options, put it on the whiteboard, which we had behind us, and trying to keep roughly square, which, just by looking at the whiteboard, that's how we sort of looked at it. And we came in one day and the cleaner had wiped the whiteboard. So effectively, we didn't even know what our positions were. It was a bit of the Wild West.
These days, everybody talks about like these fintech solutions, or everybody's got Excel sheets and is advanced beyond that in machine learning. But I really wonder, like a lot of times just handwriting down things over time, even though it's a pain in the ass, is like you build that intellectual dexterity, or you build it almost in your kinesthetic memory that you have much more facility with options if you actually, and you find where the mistakes are. Is that true, or am I just over exaggerating?
100%. I mean, I literally have most of the portfolios in my head. And if there's a return, if there's a performance figure that doesn't match, I go and look and see why. So I kind of know what it's going to do in my head, and that's just from years and years of doing that, I suppose.
Yeah, I think your subconscious kind of raises alarm bells for a number that's off, and then that's where you go kind of investigate.
Yeah.
That's fair enough. And then, so why did you move from South Africa to New Zealand?
Well, we had a startup called Peregrine that went really well, and I had visited New Zealand a couple of years earlier. I was very impressed with it, and I decided that's where I wanted to raise my children. So I left and literally arrived in New Zealand, not knowing anyone, and really enjoyed it. And I still think it is one of the greatest countries in the world.
Well, that's aspirational. Like, how old were your kids at the time, just to give people an idea?
7, 5, and 3, I think. Yeah, they were small.
I can't imagine. That's the almost exact ages of my sister's kids, and I can't imagine them upping stakes and moving to New Zealand right now. But it's, I guess, a different time. But it belies your sense of adventure and intellectual curiosity.
Yeah, and then I did a music degree for a couple of years and never passed. Actually, they didn't have high regard for my musical ability.
And if I recall, that was in jazz, right? And so I don't want to draw too much of a parallel, but what do you think about the relationship between, or correlations between, jazz and options and kind of riding waves and thinking about improvisation?
Yeah, they all have a common thread. They all intellectual puzzles that generally cannot be solved. You can get closer, but you can never really. It's like golf, I suppose. You can get good, but you'll never get to the end.
Part of that, do you think that, like, obviously these days there's a lot of like machine learning AI conversations and, will the machines take over humans? But part of that idea is they always talk about closed loop systems, right? Like AlphaGo can be, chess, and you have a constrained rule set. But then when we talk about life and options and financial markets and jazz, they're just open-ended and you have so many variables. Yeah. It's like, without a closed-end rule set, do you think they can ever catch up, or it's man plus machine is the future?
It's a massive debate. I think in terms of options are predicated on future volatility, which is a guess. And future volatility is a function of unknown unknowns. So AI cannot know, and we can't know, what the future is going to bring. So it's going to be remarkably difficult for AI to, like you say, in closed loop systems, fantastic. In things like, I'm fairly confident that AI will have it's almost impossible to predict volatility. We know that it's persistent and has certain characteristics, but it is generally unknowable. The only thing about options is they are mean reverting around a unstable mean, and that's over the long term. So short dated options, it's a lottery ticket. Long dated options, you can generally, if you buy yourself enough time, you have generally a better idea of what the volatility footprint is going to look like in broad ranges.
Yeah, and we'll come back to that, or like the difference too between the longer term volatility, et cetera, and how you view that. But I'm also, like every great story, you kind of like stumbled in or forced into starting a hedge fund when you're in New Zealand. Why did you start up a fund when you're there?
Yeah, I mean, we were just running our own capital and we were quite happy doing that. But in order to get ISDAs, we needed to start a fund. So we got a couple of friends and family in just to make up the numbers. And that's how we managed to get our ISDAs from the banks. And in those days, it was a lot easier to get ISDAs than it is today. So we were off to the races. And so we had access to the OTC option markets. And we were up and running.
Just to provide some context, like what years were those and what was your kind of strategy at the time?
We started off in the listed space in 98 and generally got our faces ripped off 98, 99. Caught 2000 pretty well, 2001. And then we decided we didn't want to just deal equity options, that the opportunities were multi-asset class and we needed to go OTC. And so we launched at the end of 2001 our first fund, which was basically taking 25% of the portfolio in options, in long-dated options, putting the rest in cash. And at that stage, interest rates were pretty good carry there. I think they were 8 or 9%. So the cash basically carried the options. So, yeah, it was, yeah.
The good old days when we actually had some 90-day T-bills actually had some juice to them, but isn't it also kind of, well, on longer data it's a bit different, but isn't it also kind of factored into row? So it's also kind of priced into the options as well, though.
Yeah, but row is an interesting. It is, but it's not really taken into account by option traders, especially now.
I know, especially now. Yeah. Nobody even talks about row as heard of row, but that's why I was asking you. As in the 90s, was row prevalent? Because I keep wondering if row is going to come back, but nobody ever mentions it at all. So that's what. I was curious that it's not part of the process. So then, when you decided to go to London, is that just a sense of adventure again, or is that just better access to capital markets and investors, et cetera? Or
well, again, we did 2001 and 2008. We did pretty well, and then 2008 we did really well. And in particular, we had a dedicated Black Swan fund. We were marketing it throughout 2007 with actually very limited success. And I remember thinking at the time, so it was a 2.5% of your portfolio spend. In 5-year options, the bleed was 50 basis points a year, and we expected to make 10x. So we expected to make 25% return for the overall portfolio on event. And yeah, we got some money in it, but to my mind, it doesn't get better than that. I mean, vol was really low, and it ended up in 2008, it did really well. And on the back of that, what really set us off to London was we had a Bloomberg news story that ended up being the top news story in the world by algorithm, I think. It was just by pure, because it was a local Singapore news story that just got bumped up to the top pages. And that created a lot of interest. And, people said, look, great idea, happy to invest, but get to London, Chicago, Singapore. We're not coming down to New Zealand to do due diligence. And so we decided, let's go to London.
Yeah, and do you think that's a lot of those, especially at the time, institutional allocators check those boxes? They want to visit your office. They want to see it's in an economic or financial center. But don't you think it's crazy that now you could be in New Zealand and do just fine, don't you think, and especially in Zoom culture?
Yeah, no, probably the same. I mean, I think we only had 2 institutional clients come to New Zealand. One had a girlfriend there and one loved trout fishing. And that's the only way we managed to get them to come down there. So they need to kick the tires. And that's fair, especially in 2009. It was critical, post Madoff, post 2008, it was critical. And I think it still is critical to do good due diligence. So, I think you've got to be in one of the main centers that make it easy for people to come and kick the tires.
In relation to 2008, I want to bring up something that's interesting is in 2007 or even 2019, we have this beautiful serendipity when you're buying options, or especially buying leap options, is that volatility compresses right before the event, right? So those options get cheaper and cheaper in like a Minsky sense right before the event happens, which is unbelievable serendipity. So it's great when you're buying the options, you can really load up on that inventory. But at the same time, I think you've talked about that's when your investors start capitulating. So it's a kind of a leading indicator to you when people are pulling their money.
Yeah.
You're getting excited in a way, even though you hate losing that AUM.
It is. It's one of those tells when you get a rash of predominantly retail. And I mean, there's no, I consider myself a retail investor as well. The temptation to do the wrong thing at the wrong time seems to be overwhelming in a very short time window. And I noticed that trading, over the years in all asset classes. So, when there's a rash of investors redeeming from the fund, particularly retail, that to me is a very interesting tell. And generally near the bottom.
As it always is. It's like the shoe shine boy problem kind of in reverse. I also wonder, in 2008, one thing that always makes me nervous is their OTC, understandably, is the counterparty risk. So in 2008, you make a bunch of money, but you need the counterparties to still be in business and pay you out. Yeah. But I'm curious how you handle that with like diversification, cash sweeps. How do you handle that process to make sure your counterparties are good on that bet?
Yeah, well, we were extremely lucky in 2008. I suppose that's the only way you can describe it. But subsequent to that, there are some horror stories where you've made the money and the bank just refused to pay you. And I've heard of other, guys who said they had winning positions that their margin got increased 32 times on them and they were forced out at less than optimal prices. So the first thing is to make sure you have excellent ISDA contracts. So we spend a lot of time making sure that we have very tight, very good ISDA contracts. Then if you're comfortable with the ISDA contracts, a lot of it is now margined. So OTC contracts are, I would say, they're very similar to listed in terms of risk now, because if you look at the cascade of obligations in a listed exchange, the same counterparties that we deal with, the JP Morgans, Goldman, they all the clearing members of the exchange as well, and they the third or fourth tier. They holding in a can if the top three levels fail. So I'm very comfortable with the risk now. There is margin pretty much on all OTC contracts. It's created I think just on that point, it's good for me. It's good for all OTC holders of options, but it has created a bigger systemic risk in that in options, OTC options alone, I think 60 trillion outstanding. And before 2008, the market moved a long way and there was no margin payable, no collateral posted. But now you've got 60 trillion, you've got a 10% move in the markets. You've got an enormous amount of collateral that needs to be posted that never used to need to be posted. And I think that was one of the big problems in February, March 2020. But no one really sort of discusses that as a risk. But I think liquidity risk by, the shortage of collateral is partially due to the fact that OTC options are now margined. So, I'm quite happy with the risks of running either listed or OTC options.
But I actually love this topic conversation because, like you're saying, is like the intertwined nature of the counterparties on OTC and then their involvement in the listed exchanges. And now on the listed exchanges, we maybe have 4 different players. It's consolidated to 4 players that are really getting that payment for order flow on the option side. So that's where liquidity is only coming from 4 players. So as long vol guys, right, we had to think about like end of the world scenarios, like where we have a perverse mind. And so I'm curious, like we've never seen like the listed exchanges shut down. Like, do you think that's a possibility? And like, what are kind of the commensurate risks of that? Because if liquid exchanges go down, it's probably going to cascade into those OTC contracts. And it's like, who's the buyer last resort? Is that governments? I mean, how do you make good on those on your options?
Yeah, I think I don't think it is really. I don't see that as a real risk. I mean, if a broker can't meet, if a client can't meet his obligations, it falls on the broker, and the broker hasn't got the capital to meet those obligations, it falls on the clearing member, and if the exchange reserve fund first, then the clearing member, and if the clearing member can't, and that's joint clearing members, then it falls really to the central bank. That's the financial system gone. So I don't think, and I think with initial margin and variation margin, it's a good system. It is quite robust unless you had a catastrophic event where the market was off 30-40%, or a market moved 30-40%, and it was a huge market. So yeah, I don't see that as a great systemic risk.
Yeah, that's why we like listed exchanges, because as you just illuminated, is like the tranche levels of margin that are covering those positions, from the actual traders to then the primes to the FCMs to the exchange. And then my answer always is, if the exchange goes down, that's obviously too big to fail, and the government steps in. It's our best guess in that scenario. But
yeah.
once again, it's the time frame though. Like, you might be tied up for months to years, but hopefully you get paid back. So I want to take a step back for a second, and let's start kind of at the basics of what are leap options, and why do you love leap options?
Well, leap options are long-dated equity options. But, I like, leaps as well, but I like long-dated options per se. And there's very good reasons for that, in that the longer you go out in time, I think the more the square root of time, as it's elucidated in the formulas, it tends less to hold. So if you look at an option contract over 3 months, you can be wrong on many things, and it's not really critical. If you buy a 10-year option and you're wrong on your parameters, it can make an enormous difference. You can go and do it on a normal pricing model on Google. Take a Google option at the current price, double it, and do a 5-year option on that price. If you price it at the lowest Google has ever traded in volatility terms, you might pay 30 cents for that 5-year option. If you price it at the highest it's traded, you might pay $300 for that option. So now you're telling me, and that's the only variable is implied volatility, our forecast of future volatility. So you telling me the pricing model can basically tell you it's anywhere from 30 cents to $300. And if you sell it at 30 cents and it goes to $300, you are out an enormous amount of money. So yeah, I suppose where we look at it and say, okay, we're not sure where it's going to trade. A 5-year option is, but we can look at its volatility footprint and its range, and we can say, yeah, at $30 is probably its fair value. Over time, without prior knowledge of what's going to happen in the markets, if it gets to $1, yeah, we'll start being interested. If it ever got to $100, would we sell it? I'd be tempted, but like I've always said, you never get killed jumping out of a basement window. I don't like selling even expensive options. It's a valid strategy. They overprice probabilistically. If you did that for a long period of time, you would make money. I'm quite content buying undervalued options and holding them in a portfolio.
There's several things you said there I want to break out. One, like you just said, even selling options at a high implied volatility, or what you think is obviously you have the counterintuitive fact that as implied volatility expands, actually you widen the distribution. So now you have even higher probability that you could get your face ripped off. Going back is like leap options are for retail is like probably 2 to 2.5 years out. But like you said, you like long dated does, and that allows you to get 7 to 10 years out, which is unique. And a lot of people wish they had access to. But I think going back to what you said initially is if you think about Black-Scholes formula, et cetera, is the one thing that's a guess is implied volatility or Vega. And so this is what essentially you're isolating with long dated options. And that's why you think you can have an advantage there. Is that fair?
Yeah. I mean, and a lot of times it's just uncommon common sense. In about 04, 05, the banks were very keen to sell gold call options, because and the very good reason on the other side, the gold mines get the premium, and they don't really mind. They've got a program to sell call options to get some yield in, and they've got the gold in the ground, so they're not really that bothered. And they'd been doing that for a long time, and the price had been coming down. So you could buy a 5-year gold call option, strike 500, and the spot was 450. You could buy a 5-year option, strike 500 for $30. And I sit there thinking, well, if I wanted to buy gold spot, I would have about a $30 stop loss anyway. So why don't I just buy the 5-year option and leave it? If it goes down, I've lost my $30. If it goes up, I'll run it. And so we loaded up on those, and twice gold dropped back to below 400, and our P&L took a bit of a hit. I think the option price went to $20. It didn't massively change. And then it started to run. And then you have, at that stage, I think we had 3.5 years to run. Every $30, we were making 100% on our options. So, and this, once it gets to around 700, you don't really, you're happy to keep on running it. So, yeah, that is clearly a cheap option. Sometimes they just shout at you.
Well, part of that is like there's a lot of argument if options are overpriced or underpriced, and then you said fair value. But is it as simple? I mean, obviously you have modern tools and techniques to kind of assess those values. But at the end of the day, is it classic value investing of almost like you have a margin of safety? They shout at you, they're so cheap that you just want to load up on those cheap options.
Yeah. No, we like to, because we're scanning the whole world looking for options. We like to buy options we think are massively undervalued.
And that's part of it. Sorry, go ahead.
For one reason or another. The reasons can be many and varied. It can be interest rate differentials. Interest rate differentials make some options extremely undervalued and some extremely expensive.
And that's part of why I really fascinated by what you guys do. You guys call it pan asset class or cross asset class. Like you just said, you search the globe for cheap convexity, essentially. But tell me about how you put together a book of using all these different asset classes and how you think structuring the book that way.
Yeah, well, I mean, running a portfolio of options is like trying to herd cats. It's not a particularly easy exercise. So we started off with a trader's mentality. We just put a portfolio of long-dated options together we thought really good, and then we started thinking, well, we want to run a U-curve, we want to make money in any market environment, so we want some options that will benefit if the market goes up, and we want some options if the market goes down. And so we started to bifurcate where we felt the correlation to, call it S&P was. If it was positively correlated, we'd try and balance positively correlated and negatively correlated. So in any environment, we're going to make some money, except a quiet environment. And then that was the sort of first, and that takes some, some working out. Then the next sort of evolution was we discovered a whole raft of options that carry positively, that we can use in the portfolio to carry to offset the theta that we're doing on our convex options, which are the high convexity options. So now we blend the carry options with the high convexity options, and that then you're looking at correlation. You want to make sure that over every market environment, given certain correlations, that you have a robust portfolio that you won't lose on both your carry options and your convex options. And if you are going to lose on your carry options, your convex options will kick in and overwhelm them. You overwhelm losses and still make profits. And that, I think, that's sort of approaching the holy grail of running an option portfolio. If you can run an option portfolio like a Dutch book, and running an option portfolio is a lot more like a bookmaker than it is a traditional investment manager. So you want to try and get a Dutch book, which is basically, no matter if you've got a 10-horse race and you're the bookmaker, no matter what horse comes in, you're going to make money. And it is possible, it's doable, and that's the holy grail of options, is to get that blend and understand your correlations well enough and build in enough resilience in the portfolio that you make money in pretty much any conditions. And so, there will be volatile, sometimes there will be losses, but we look at it over a rolling 5-year period. We're really confident that it's a robust portfolio if we decide we want to carry neutral and make a certain amount of money, or we want to yield 5% and have slight convexity, or we just want to run extremely high octane portfolios and use some of the carry just to mitigate some of it. So that's kind of where we're at now.
Yeah, I want to come back to how you structure the carry neutral book. But then thinking about just on the long convexity side of pan asset classes, do you think about constraining any particular asset class, or is there an aggregate constraint on those options, or how do you layer those in?
We've got risk limits. We constrain counterparties to 25%. That's pretty common sense. We constrain asset class limits to 50%. So we could be totally invested in 2 asset classes only, which is pretty broad, but it gives some diversification, and 30% in any one particular position, which is also wide, but is fair.
And then, as you referenced before, what's nice about trading a long book of options is, like when you reference the gold option, when gold sold off, it went from maybe 30 to 20, is like you have concavity to the downside and a truncated downside because you're paying premium. And then you have an unknown convex upside. But the whole point is it's unknown. So then we start to get into this position of, how do you think about roles and monetization? So the interesting thing is, if you're buying 7 to 10 year options, it's not terribly different from buying a bond, right? You kind of know the terminal value, but it's the football in between that we play, right? Like it's how the P&L just can dramatically expand and contract. So that begs an interesting question. If I have a 7-year option in year 1 or 2, all of a sudden Vega dramatically expands, but it can also mean revert just as quickly. How are you thinking about rolling, monetizing, maybe tranching effects? I know that you guys use. How do you that's the really tricky part, right?
Yeah, it is. It's tricky, but we stumbled across our methodology, and it's been pretty robust for many years, in that we've got 2 basic regrets when you buy an option. You buy an option, your first regret, you regret if you buy it at $1 and it goes to 0. But that's a risk you run. It's the price of doing business. But the main regrets, if it's profitable, if it goes from $1 to $10 and goes back to $1, that's a big risk and a huge regret. And the other one, and that's, you can buy a 10-year option. It could have gone to $10 in 6 months into the option. And you decide, I've got 9 years left, it's going to go more, and you leave it, and eventually whittles down back to 0. And the other one is you set a price target at 10, you get out of the option, it goes on to 40. And okay, it's a less of a regret, but it is a regret. So what we do is we put profit stops underneath it. So if an option goes from 1 to 3 times what its original premium was, we put a 60% profit stop. Goes to 4 times, we tighten it up. 5, 6, 7, 8 times. 8 times got a very tight profit stop of 10% under it. And then after 8 times, it's discretionary. So we can get out of it, but there's a hard stop at 10% under 8 times. And we find in that way, it takes all our thinking away from us. We know if it keeps on running, if it goes 12 times or 15 times, we can let it run, but we've got a hard stop at just under 8. And if it gets to 8 and falls back, it's out. Sometimes it gets to 4 times and falls back, it's out. So we know at every level, in the heat of battle, it's hard to have a plan. So in this way, with a lot of options pointing in different directions, get really volatile. We don't have to try and outthink when to monetize a portfolio. So
I think you have like these contradictory forces too. Is like when the price dramatically expands, obviously you want to monetize as a business because obviously it helps your P&L. But at the same time, that people are using you in their overarching book to protect against like once in a 5-year sell-off or once in a 50-year sell-off. Yeah. So that's the really hard part about monetization, because you need to have some of those on the books. Like you said, if you monetize at 10x and it runs to 40x, then you haven't provided that protection, and that's a really difficult process that people don't realize.
Yeah, that's right. Yeah, that's right. It's a dilemma.
And then think about two aspects of rules. Like, so you had 2 problems, right? Like, let's start with a simpler one. Let's say I have a 7-year option and 3 years in, nothing's happened. At what point are you rolling? How much time are you leaving on those options to like kind of roll into new options?
We only really look at it when it's got a year left to expiry. We can do a bit of housekeeping and we could trim it up, but generally we don't do anything until it's got a year left to expire. That's when the theta, how much Vega you get for how much theta, how much the cost-benefit analysis really starts to skew against you. And the last 3 months even worse. So we find if we've got a position, we still like it, we can roll when it's generally about a year.
And then part of that is then the secondary way I think about it too is like, let's say you go through a period in those first couple of years where you're able to monetize or you hit your tranching monetizations or your stop loss. But as you know, now you got to re-up your book. You got to get more options back on the book. Yeah. And now Vega is probably higher, so you're going to like pay a lot. Is this part of your pan asset class approach? Is that you can still think you can find cheaper Vega where Vega hasn't expanded in other markets to kind of relayer that book?
Yeah, exactly. So like at the end of 2008, we were 95% in cash. Literally because we long ball and there were no opportunities. So we want to be highly invested when vol is low and the options we think are value. And we want to be out, we want to have monetized them and be out in cash looking for other asset class. And this is where multi-asset class pays its way in spades. In 2008, I mean, things were falling apart and was doing well, but I think well into 2008, Australia and New Zealand were still raising interest rates when the rest of the world were running down to zero very quickly. So, yeah, someone was going to be wrong. And we took the bet that, if this crisis deepens, Australia and New Zealand would have to reduce their interest rates massively, which is effectively what they had to do. So we had monetized some options and we recycled the profits back into swaptions on New Zealand dollar and Australian dollar interest rates. And generally, even in 2009, when implied vol was really high in equities, there were opportunities in currency. So we feel that in systemic crisis, you do tend to see cross-asset volatility correlate to one eventually. Although in 2020, in the COVID crisis, currencies didn't participate. But I think given another month or two, they would have. The central bank successfully stopped that in its tracks, which, well done to them. But I think, generally all the asset classes generally start to participate in volatility.
And part of that, like, that's thinking outside the box, like we were saying, what if the exchange, the listed exchanges went down? Is I always think about in the modern era, we haven't seen like a second or third leg down in the modern era, right? And that's what, like, you're looking for those other asset classes to protect against. Like, if March 2020 we see, let's say, implied volatility expand to 80, comes back to 40, you're selling them out. And then what if we have a second, after a bounce back, all of a sudden it shanks off another 50, 60% in S&P. But now a lot of tail risk managers do not have protection on because they've gone to cash and they monetize all their positions.
Yeah. Well, that's the dilemma. It is a big dilemma. I met a oil trader. I don't think he was trading oil at the time, but he said oil implied volatility generally topped out at about 40%, I think it was. So as it approached 40, sold oil volatility. I think it was the first Gulf War hit. He bought it back at 120 implied volatility, went long at 140 and sold out at 200. Implied volatility is just number. It can go anywhere. It's very difficult for it to go to zero. It is surprisingly easy to go to any number. 80 on the VIX, it could be 180. You never know how potentially high it can go. It depends on what people are willing to pay for options at that point in time.
And then part of that, you said in 2009, you were looking at FX or currency vol didn't really pop. Do you feel kind of like the same way now? That's where you're buying. You were like it's calmed down since March of 2020, but in mid to late 2020, were you guys like kind of rolling into FX vol, or how were you looking at it?
Yeah, we've had FX vol on our books for a while, and I think it's multi-decades cheap. An annualized implied volatility of 5.5%. You're basically saying that currency is going to go up and down throughout the year, a maximum of 5.5%. It can do that in a day. I've seen, I think in 98 or 99, the yen moved from 150 to 120, I think, in a week. We haven't seen that for a long time. The Forex markets have becalmed. But we've got interest rates at the zero bound with a desire for central banks to keep them there, which means that any geopolitical uncertainty will probably reflect in the currency rates. And now you've got inflation emerging, which means different currencies will start to suffer different effects from inflation or deflation. And so I think currency rates will move a lot more in the future than they have in the next 5 years are going to be totally different to the last 5 years. So I think that is a major opportunity.
What I love about your strategy, though, at the same time, is like you can be two Jerrys, right? Like you can have your view of prognosticating the future of what you think should happen in FX, based on what's going on in the world. But then the Jerry portfolio manager of the options book is like, I'll just buy cheap options, and if nothing happens, I know my downside. But if there's convex upside, I'm going to be there to participate. Is that like it's almost like a trade-off? You're like two people in one in a way.
Yeah. It's Options is like it's a probabilistic outcome. You put a certain amount of money down, there's a probability that the event will occur. Now, there's an analogy that if you went to a casino and the croupiers were allowed to give you variable odds, so you suddenly hear on a table down the road they're offering 100 to 1 on the number 17. Where clearly the real odds are 36 or 37 or 38 to 1. the odds are clearly in your favor. And if you manage to find enough of those bets and put them in a portfolio, you would make money over time. That's an investment. If 5 17s and come up on a single table, and the croupier is now terrified of 17, and she only offers you 5 to 1, the real odds of it happening are once every 37 spins, say, and you're only going to get paid $5 if it comes up. That's a terrible bet. And that's exactly the same in the options market. All you have to do is wait until the premium's low enough that the odds are in your favor. The only wrinkle is you're dealing with uncertainty as opposed known risk.
No, that's a great analogy and a way to think about it. And I would be remiss if I didn't go back to point out, and I'm not trying to do a marketing pitch for you to yourself, but I always think about the pan asset class idea is that, during a risk on cycle, if you have pan asset options, you might get a pop of volatility in any sort of asset class, and then you're monetizing it. That helps, on that carry during the risk on cycle, and then risk off. Correlations tend to go to 1. So across your book, you're just having great returns. And then like we were just discussing is after that risk off event, now Vega or implied volatility is higher, but you can find little pockets where it might be lower in different asset classes. So in the 3 stages, it's like you're kind of covering yourself across those 3 stages of market environments.
Yeah. And the other nice aspect of being in long dated options, because it's got a big Vega component. So asset direction is not as important as Vega. So if you've got an option that, say it's an S&P call and the market goes down 20%, you got a 5-year S&P call, you clearly got the wrong direction, and vol goes from 20 to 80, there's a chance your call option will be worth more than it was before. So it also limits your losses by being long volatility as well.
No, that's my one of my favorite stories from February 2020 that I tell people is that exact thing, as I know a bunch of traders that made money off of calls in February 2020, and it blows people's minds that don't understand, like, if you're buying cheap enough Vega, like, you can make money, you could be wrong down your delta and still make money. And it's always a fascinating way to look at environments.
And the longer dated, the more apparent that effect is. So on a 3-month option, you probably won't ever see, maybe you won't see that, but a 3 to 10 year option, that's quite doable.
And then you talked about, so like the evolution or new wrinkle you guys created is thinking about, you have this massive convexity on your book, and you're like, well, is there maybe a way to carry that convexity with things we've learned over the decades? And so, like you're saying, you have this new product with the carry neutral protection, and you're saying you're using, spreads or, neutral to positive carry options. Like, what does that look like? Give me an example. Like, what do you mean by seeking out these positively accruing options?
So they just basically call or put spreads that are positioned between the forward and the spot. I'll give you an example now. The ruble now, what we're trading about 71.50 spot today. 1 year ruble is the forward is 77, I think, roughly. So you can buy a strike 77 strike ruble call option and sell a strike 72. So you got a spread call option, and obviously the ruble has to go appreciate. It's going to go down, and it's at 71.50 today. If it stays at 71.50 or anywhere below 72, it will realize about 100% in premium. Because we outlay, I think it's 30,000 per million. If nothing happens, it'll be worth 60,000 simply because the forward has drifted down to the spot from 77 down to 71.50. So here we've got an option that actually is accruing if nothing happens. And on the same time, we've got an option that is losing money if nothing happens. Now, if we can put them together and their correlation is good enough, the one will pay for them another under multiple market scenarios. And I'm not saying that the ruble is a good counterbalance for the S&P put, but like the euro also does the same thing. It carries positively. And generally in a market crisis, the dollar strengthens. And this is a euro put, so you basically long the dollar, and then you have these highly convex options that also make money if the market goes down. So it's now you're in the realm of, we can get a carry book that is quite robust over every market regime, up 10, up 30, up 50, down 10, down 30, down 50. We roughly know where it's going to be. And now we roughly know what we're going to generate from that. And now we can use that money to buy the highly convex options that produce meaningful performance if the market's down, in that carry neutral fund, if the S&P is down 30%. And it's kind of, it's a product that appeals to people because it's carry neutral. There is a behavioral bias against negative carry, which I've never really understood, but it's there.
Well, and a part of adding that carry neutral, then obviously you're giving up some of the convexity on the negatively correlated part of the book. But But what are it's one thing to hunt for these idiosyncratic, positively accruing spreads, but to put them together in a book, the way you guys do, they talk to me about, like, that's a lot of system design. That's a lot of computational horsepower to figure out the correlations across the book and to add those all in. Like, how long or what was the process like of actually building out the system design?
Yeah, well, that's where the interesting work really starts, because everything's dandy if you have one correlation matrix that you assume correlations won't change over any market regime, but that's clearly doesn't happen. So you got to get to a position where if the market was down 30, are you comfortable with the correlation matrix that you've got today? And the answer is clearly no. So what's your best guess at what the correlation matrix is going to look like when the market is down 30? Go back as far as you can and find every time the market was down 30, look at the correlation matrix and form a new correlation matrix that's just for that market regime, maybe down 20 to down 30. And that's your best guess. I don't think there you can't really get better than that. You can't, yes, it might not be that, but a lot of the things will be the same. And when the market's down 50, the correlation matrix will change again. And so we look at all extreme events. When the market's up 20, the correlation matrix will be different. So I think that's where we differ. We now plugging in what we call a family of options, and we plugging in all these different correlation regimes to make sure that it'll be robust if we get to that environment and that correlation matrix kicks in.
How dare you say best guess in a world that everybody wants precision, but that's the probabilistic distribution. And it's honesty, right?
Well, the classic conundrum now is, for the last 30 years, you could count on interest rates going down if equity markets went down. And so that's like pretty hard baked into a lot of the correlation matrices. But what happens if rising interest rates cause the equity market to go down? Now, clearly, this is a scenario, the risk parity blow-up scenario, which I think is probably a lot more probable than the market gives it credit for. And in that scenario, pretty much every correlation matrix we have for the last 30 years will break down. Notwithstanding, there will be wholesale panic in 60-40 portfolios when both their 60 and their 40 are going down together. And so that's just an example. It'll always be a little bit of art and a little bit of science. I don't think I would love to systemize my portfolio I don't think it'll happen.
Well, that's why we all run shock tests, and I love them and hate them because at best they're intuition pump, but really they're rear view mirror looking, right? So they're going off past correlations and past market regimes and shocking your portfolio if, a certain event kind of happened in the past, whether it's 87, 2008, 2020, or 2015, all those things. Those are the shock tests we use, but like it gives you an idea, but it doesn't give you certainty. And I like that you talked about you guys shock to, you say 10 plus market regimes, but to be clear, what you mean by that is like, if the market moves this much over this amount of time and you tranche those out into 10, and then you figure out the correlations based on that in those past market regimes. But then you have the human overlay, the art of saying, but what happens if interest rates go up? And we haven't seen that in that correlation matrix. And it's almost like, so the 10 market regimes are actually just strength or speed of move up or down? Is that how you tranche out the 10 markets?
Well, it's like, like what will the Thai baht do when the market's down 30? What will the Thai baht do when the market's up 30? Now, I don't intuitively know what will happen. So if I've got a carry option that involves the Thai baht, I need to know that, and I don't intuitively know that. I have to rely on the correlations as they existed for the last 30 years in every different market regime. It may or may not occur, but I think the odds are probably in our favor. It will be similar. But there will be scenarios like interest rates versus equities where it won't be similar. This time it will be different, and you got to be on the lookout for that as well. And it doesn't take much to buy some optionality to get rid of that risk. In fact, that risk, because the correlations have been what they are, you can buy a conditional option very cheaply that of both the equity market and the bond market prices going down together. That's probably one of the cheaper. I think you get about a 70% discount.
Well, that's interesting of adding those dual digitals in, but a part of the overall book where you're covering a path dependency that your other options aren't covering, instead of just looking to buy dual digitals and waiting for that parlay or that accumulator to take place. It's very different if you're pairing it with the rest of your book, knowing this is where I could potentially get hurt.
Yeah, just plugging risk holes. Again, what you're trying to do is end up with a Dutch book where in every scenario I will carry neutral, I'll be around zero. And if the S&P is down 30, I'll make whatever I make, 40 plus. And then where can that go wrong? Plug every risk hole and run it. And, if the client likes that profile, they'll invest.
And we're obviously big fans of pairing relative value, positive carry with deep out of the money convexity. But I'm curious how you think about there's a bit of belly risk, or another way to say it is like you have, ceteris paribus, your positively accruing options are going to do well if nothing happens. As the sell-off continues and then your convexity kicks in, usually there's a relay race to that handoff. And that's where maybe some negative P&L can kick in between where relative value gets hurt and then the convexity kicks in. And I'm curious how you guys think about covering that. Or leaving it.
Yeah, I mean, you can never cover every potential scenario. So you're right. There can be a scenario where your carry book is losing money and your convex options are losing. They're just beginning to kick in, but not enough. In which case, you just leave it. And if that situation occurred for a year and you go down 10% for the year, just march on to the next year. It's a very unusual scenario for that to happen. And, these sort of 2 standard deviation moves are irritating. You want the convexity to kick in or you want it to do nothing. But the next year the chance of that doing that kind of sort of half feint and never really following through, then of course it can always come back. So it can go the 2 standard deviations, you get a mark-to-market loss, and then it comes back. And you're in the same position and you're 3 months down the track. So yeah, it's a risk, but I don't think it's a huge risk. And again, because we try and diversify our carry book over a lot of market scenarios anyway, that even that if that did happen, hopefully we'll have some options that will make money in that environment anyway because of asset direction. So, yeah.
I only bring it up.
It's not without risk. You can't run a Dutch book totally without risk.
And that's all I was trying to do, is highlight that there always is a commensurate risk. So it's almost education from our parts. And I bring it up without talking specifics, is the from the pain of here that we just went through in September 2021, where those kind of scenarios happen, where you almost get pinned to that 2 standard deviation. And so it's always incumbent on us to remind clients that there's nothing without risk. And this is where you could potentially get hurt. But over the long run, you're going to be better off running this Dutch book. And sorry, I don't know if you have anything to comment on that. I was just fresh in my mind in general.
Yeah, no, that's right. And it's, that's why we focused, because a couple of years ago, the correlations went against us and we got quite a severe P&L hit in another fund. And that's what forced us to look at these different correlation regimes. So in many respects, it was the best thing that ever happened to us. It wasn't pleasant at the time, and it came back after that, but it was concerning. And that, the best learning happens through failure.
Well, that's because during the wins, we tend to think we're geniuses, so it's hard to learn during those wins. Yeah. I was right all along. So I kind of want to wrap up with some more, like, kind of not rapid fire, but just like some ways of tying a bow on thinking about options. And one of the things that you and I are big fans of that I don't think gets maybe reiterated enough is the idea with buying long options, especially, or just buying options in general, is it's non-recourse leverage. Like, just tell me, like, talk about the value of non-recourse leverage. It's very few places you can find it in life.
Yeah. Non-recourse leverage is the holy grail. And in fact, just as an aside, I think the way the US property market is structured, you got it's non-recourse because it's very difficult to throw you out of your home in the US. It's also a resettable strike, because if the value of your home goes up, you can remortgage and set the new strike price, in which you can't lose any more money. So in effect, you're buying a 30-year non-recourse resettable strike call option on property. Well, that's a fantastic option. That's a fantastic option. And in fact, I would argue that should continue until it breaks the people who are selling that kind of option, which is, it's a great option. And so non-recourse leverage is one of the 8th wonders of the world. If you can put $1 and have the potential to make $10, and if it doesn't work and it goes down, you only lose the $1. It's the same as if you've taken $1 and borrowed 90% of the funds from the bank, non-recourse, and invested in that asset. And if the asset went pear-shaped, the bank takes all the losses. It's very that kind of optionality is valuable.
Yeah, actually, just this past weekend, my partner and I were discussing that, and people don't realize as Americans that how lucky we are to have non-recourse leverage on single family homes, because that's actually not prevalent worldwide.
Yeah. I mean, I think you can't get a maybe maximum 10-year option, 10-year loan here. In Europe, you can get 30-year as well. That's a 30-year option.
But also in like places like, I don't know how it is, and it's probably country by country in Europe, but like in Canada, it's recourse. It's non-recourse. You can still get the 30-year mortgage, but it's a recourse. It's not a non-recourse.
No, it's not a non-recourse. Yeah,
which is a huge, as you know, huge difference. But then what you have then is you have the social construct risk, right? Your recourse is social construct that you look like a failure to your community if you default on that debt. That's it.
Yeah.
It's a very fair way of looking at it. So the other thing I brought up earlier is like, there's this interesting, like I said, Hyman Minsky like moment in 2007 or 2019 where volatility gets suppressed and gets cheaper and cheaper right before the event. So I want to talk about like as options traders, it's like we're inventorying liquidity, right? It's risk transfer services or we're liquidity providers. But I always think about it as an inventory on a shelf space, like in a store. And like you're saying is like when it gets cheaper and cheaper, you're buying more in inventory. You're waiting for the event to happen. The event happens, and all of a sudden, there's not maybe a ton of liquidity there. The event happens, and everybody rushes in to buy your inventory, and liquidity is expanding. So it's this countervailing force of actually you're playing with liquidity in and out of the market, but you're also inventorying liquidity during those cheap and dear times. Yeah. Is that a fair analogy, or would you extend that metaphor a little bit?
I'll give you an analogy, and probably not a very PC one. Imagine you in the trapping business.
Okay.
You're in Canada somewhere, and you're trapping, and you're trapping in a valley somewhere, and occasionally you have a migration of a lot of animals come through, but for the last couple of years you've seen nothing. Now you can go to the general store and you can buy a trap that rusts away in a month, or you can buy a stainless steel trap that lasts 10 years. So, some people buy the ones that rust away in a month. Those are the short-dated ones. Some people buy the long-dated ones. But there's been no animals in the valley for 5 years. There's been no returns. All the trappers are giving up in disgust. They're all sending their traps back to the general store. And the price of the stainless steel traps are really low. So you load up, you go and buy all the stainless steel traps. You put them out there. Well, the price is so low. It's not really a big deal. I don't think the price of the traps per se are going to go any lower. Now, after 6 months, all of a sudden the animals come through the valley, and you're catching all these animals with these stainless steel traps. You're making a lot of money on that side. Now everybody wants to be a trapper. So now the price of the traps at the general store, which is the reval of options, goes mad. You uptake all your stainless steel traps, which have got 8 years life left in them, go and sell them back to the general store 10 times what you paid for them. And you've caught the animals as well. That's
I'm smiling the whole time because every time I think I've heard all of the analogies in our space, you always surprise me with a new one. And it reminds me of almost like, in a way, it's like the old analogy of selling picks and shovels to gold miners, right? That's what we're doing. We're just waiting for that gold rush to happen, basically.
Yeah.
That's a great way, I think, looking at it. So when I was thinking about, I knew you and I were going to talk today. And yesterday I was kind of thinking about it in general. And I was thinking about, back in the day, I used to be a soccer player, European football, right? And I had the great fortune when I was 17 years old to play against one of my heroes at the time, Carlos Valderrama from Colombia, center midfielder. Okay. I was a center midfielder, right? And I'm going against him, and I realized very quickly that what happens with Carlos Valderrama, he looks like he's effortless, right? He's just kind of floating around the field, doesn't look like he's working hard at all. If you try to mark him tightly, he'll beat you on the dribble so quickly that then you're like, okay, I don't want to be embarrassed. So I step back. And as soon as you step back, he makes a killer pass to the forward and they score a goal. So he's like impossible to mark in a way, but but it looks totally effortless. And what I think happens is over decades of experience or time goes on, we get these really cagey veterans, right? That like, they know more importantly, not what to do, but what not to do. So what I was thinking about you is like, over all these decades of experience from, nascent markets in South Africa to now and evolving into the carry neutral space, it's like you more know what not to do. Like I always talk to all the young gun, options traders, and they all have these great ideas and everything. But you're just like, to me, it's like you're sitting back and go, look, if I buy long dated Vega and I buy fistfuls of it in all the asset classes of the world, I'm going to be just fine. So it's really just reducing the core competency into the basics. And I say that in the best possible light. Is that fair?
Yeah, that's fine. I mean, it's, what do they say about experience? Experience is what you get just after you need it.
Unfortunately, our recording cuts out right here. Jerry and I go on for another several minutes, but unfortunately didn't record audio or video. Obviously, I could listen to Jerry talk for hours. I always enjoy a conversation with him, and I hope you got as much out of this episode as I did. And we apologize again for the technical difficulties, but we appreciate you listening. Thank you very much.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.